Christmas tree lot deception, income taxes, and the Supreme Court. This is Ken Boyd with the Accounting Accidentally Substack channel. So, is it immoral not to buy a Christmas tree from your church tree lot? I'm asking for a friend. There's tons of organizations that raise money by running tree lots. You probably see them in the area where you live. And the quality of the trees can vary greatly, particularly if you buy one past December 15th. They start to look pretty old. Churches, schools, Lions Club, you name it. So we all have opinions on what's fair and moral and what's not. So here's another one for you. Should individuals be taxed on a transaction if they haven't received the profits yet? Seems like a reasonable question, and the Supreme Court may answer it soon. So to understand what's at stake, let's talk about realized and unrealized gains. Very important, you need to buy and a sell to have a realized gain. So here's an example. If you buy an asset and sell it for more than what you paid for, you have a realized gain. If, for example, you buy 100 shares of IBM common stock for $10,000, sell it for $15,000, you have a realized gain of $5,000. An unrealized gain has a buy and no sale. If you buy 100 shares of IBM common stock for $10,000 and hold the stock, the value increases to $17,000, you have an unrealized gain. Generally speaking, and we'll see some exceptions, unrealized gains are not taxable. Here's why. The value of your investment could also decline. Sure, the IBM investor has $7,000 unrealized gain in my example up above, but what if the stock declined to $8,000? It doesn't make sense to tax someone on an unrealized gain when it could eventually turn into an unrealized loss. So we agree that the investor does not have the dollars for the gain yet, right? Doesn't have the money in the pocket because there's no sale. No sale, no profit. Well, what if the profits earned overseas? Which brings us to a big issue that came out just around the time of this recording. Here's one component of the Supreme Court case in the Wall Street Journal. The court will hear arguments in Moore versus U.S., which challenges a piece of the 2017 tax law that imposed a one-time levy of profits on companies that accumulated profits outside the U.S. And the case, brought by a state couple in the state of Washington, asked for a refund and raised a simple question. Must income be realized or actually received before it can be taxed? It's the same issue that I used up above with the stock sale. If the investor has not received the profits, how can the gain be taxed on profits not received? Now, so there's some exceptions to the tax code, to this rule. The government, again from the Wall Street Journal, the government contends that plenty of tax code provisions actually don't require Americans to see income hit their bank accounts. That includes rules governing taxation of futures contracts and bonds with original issue discounts. So let me use the original issue discount example. With an OID bond, let's say you buy it at $830 and at maturity, the face amount pays you $1,000. Some of that $170 difference is income, and you're going to be taxed on that interest income over time. Okay, that's something I can live with. Well, here's another one. Partners are taxed on partnership annual profits, even though they don't get a check for their portion of the profits. Sure, I'll buy that. So why is there such an uproar over this case? Well, as we all know, we're running massive deficits. We have about $33 trillion in debt as a country. And politicians aren't willing to raise income taxes or cut government spending. So where do they raise more revenue? By taxing unrealized gains on investments, that's where. And under this scenario, your investments are taxed each year based on your unrealized gains, no sale yet. Now, I assume we all get a tax deduction when we have unrealized losses, which would reduce tax collections in years when the markets decline, which you don't hear about in the media. They talk about taxing the gains. What happens to the budgets in the U.S. government when there's losses and everybody starts deducting? With both unrealized gains and losses, the wealth tax sounds like a bad idea. Tax compliance and enforcement would be insanely complex, as you can imagine. So here's a final quote from a tax expert on the Supreme Court case. A holding that is a court holding that the realization rule is constitutionally required would well cause massive parts of the tax system to become invalid. That is the big fear that would happen. So stay tuned. And for more information on accounting and finance, you can go to Accounting Accidentally, my Substack page. Thanks for watching.